previous chapter we've looked at the production of a cash flow forecast. This is going to throw up a number of different short-term financing issues, and this is what we're going to look at in this chapter. The chapter splits into two. In section 1 we're going to look at different strategies that can be used to deal with some of the cash flow issues presented by working capital movements. And then in section 2 we're going to look at the dividend decision, and clearly if you pay a dividend it will have a short-term cash flow impact. Unlike some of the chapters coming up, there are no formulas or difficult numbers in this chapter, which can mean that people neglect it. That would be a very dangerous thing to do, as it's a popular feature of parts of exam questions and has been examined quite heavily in recent sittings. Towards the end of the previous chapter, we looked at the idea that tighter working capital management can be a useful way of freeing up cash that may be required elsewhere in the business. Companies that fail to manage their working capital in an effective way will experience increasing cash flow problems as sales go up. This is sometimes referred to as overtrading. And for many businesses, if you let sales go up too quickly and you're not collecting cash from customers effectively, and you're allowing quite a lot of your production to be tied up in inventory, this can create intense cash flow problems. But for any business, good, effective working capital management is going to be critical. What we're going to look at in this section is where the additional finance that may be needed to finance working capital movements can come from. And we pick up this debate in paragraph 1.2. If a business does require additional finance to cover its working capital movements, it could take out a bank overdraft, or it could raise funds in a more long-term way through a rights issue or a long-term loan. And this is what we're going to consider next. In the UK, many businesses in the past have relied on bank overdrafts as a source of short-term finance. Where businesses are doing this, where they're clearly relying quite heavily on a bank overdraft, this is often called an aggressive way of funding your working capital movements. An aggressive financing policy carries the risk that the bank overdraft is not going to be available when you most need it. So we're going to consider different approaches that companies might use to fund their cash flow needs that result from working capital movements. We're going to use a diagram now to build up different approaches that can be used to fund your short-term cash flow requirements. This diagram has been tested. It starts off by building up the idea that a business during the course of the next year will need a certain amount of cash to fund its non-current assets. So for example, you might be in a long-term lease on one of your buildings, and also for your permanent current assets. And this phrase permanent current assets refers to the minimum amount of working capital that you're going to need. So for example, the minimum amount of inventory that you're always going to need in every month of the year, and the lowest your receivables are going to be in any month during the year. There'll always be a certain amount of cash tied up in your current assets. On top of that, during particular months, your current assets are going to fluctuate, and as your receivables and inventories go up, that's going to tie up cash, and as they come down, it's going to release some cash. So you're going to have some degree of fluctuation in your current assets that's going to affect your funding needs. At the peak of the diagram, we can see that at particular months during the year, we're going to have very high financing needs. So in these particular months, we're going to have very high requirements for funds, and there'll be a certain maximum amount of funds needed in those months. Now this diagram is very much a simplification of reality, but we're just going to work with it for the moment. And we can use it to demonstrate at least two different approaches to working capital finance. First of all, we could think of a logical or moderate approach. And with this approach, if you know that you're going to need a certain amount of cash every month during the year to fund your minimum levels of working capital and your non-current asset requirements, then you would take out a loan at the beginning of the year, effectively a long-term loan, and you would always have the funds available to meet those cash flow needs. And then if you need a little bit more cash in particular months because of your fluctuating current assets, then you use your bank overdraft. This is sometimes called a moderate approach, a middle of the road approach, and it's logical and it will be used by many companies. However, there are different approaches that are possible as well. As I've already mentioned, in the UK there tends to be quite a high reliance on the bank overdraft. Let's look at this approach now. Heavy reliance on a bank overdraft or any other form of short-term financing is called an aggressive financing approach, and it's an important term for you to know. An aggressive approach is where you're using short-term financing to do more than cover your fluctuating current assets, and it's eating into some of your requirements for permanent current assets and perhaps even your non-current assets. And we can see in the diagram that aggressive financing is indicated because short-term financing is doing more than covering your fluctuating current assets. Although in this particular diagram we're not eating into our permanent current assets very significantly, the fact that we are at all indicates that it's an aggressive financing approach. The rest of your financing needs are being met by long-term finance. But because long-term financing here isn't sufficient to cover all of your permanent current assets and your non-current assets, it's referred to as an aggressive approach. So why would a company use this approach? Well, it would simply be that with a bank overdraft, you're only paying the interest as you use the overdraft. And in that sense, it's a cheap form of finance compared to a long-term bank loan, which you take out at the beginning of the year. And of course you pay interest on that on the full amount borrowed, even though you may not need the full amount in every month during the year. So you're going to go for an aggressive approach to save money. It's a cheaper approach. The other extreme approach that we could use is described on the left-hand side of the diagram as a conservative approach. And with a conservative approach, you are going to use some short-term financing, but less than what you need to cover your movements in your fluctuating current assets. And you're going to rely on long-term financing to cover most of your funds needed in any particular month. And because you've got most of the funds that you need in place through some form of long-term financing agreement in any particular month, then you'll never run out of cash. This is going to be a much lower risk approach. You're unlikely to run out of cash. However, because you're borrowing so much money, or you're perhaps using a rights issue to raise so much money, this is going to tie up funds, and in that sense it's going to be an expensive but safe approach, hence the term conservative. It's a safe approach. These different approaches to working capital finance can be tested with numbers, and we're going to move on to consider this now in lecture example 1. In lecture example 1, we're given some information on a business's minimum and maximum working capital levels. In any particular month, inventories can be as low as 43 or as high as 74, and so on for receivables and payables. We're told at the moment that the company relies on short-term finance. So we can see the term aggressive policy. And we're told that this means for this particular company that as well as all of its fluctuating current assets being funded by short-term finance, which you'd expect under even a moderate policy, on top of that, 20% of your permanent net current assets are funded by the overdraft. So because we've gone beyond using short-term finance to finance our fluctuating net current assets, and we're using it to contribute towards our permanent net current assets, this would be called an aggressive approach. And a more conservative approach has now been suggested, and in this particular example, this means that we're going to use long-term finance to fund all of our permanent net current assets and also some of our fluctuating net current assets. So because we're using long-term finance to fund some of our fluctuating net current assets, that's what makes it a conservative approach. And the requirement of the example is to calculate the funds involved under either an aggressive or a conservative approach in terms of how much short-term and how much long-term finance you're going to use. With both approaches, the aggressive and the conservative approach, the policy is framed in terms of how much short-term and long-term finance you're using with regard to your fluctuating and permanent net current assets. So it makes sense to start with to calculate how much money is needed for your fluctuating net current assets and how much is needed for your permanent net current assets. Let's start with permanent net current assets. Permanent net current assets are the minimum amount that you're going to need as cash to fund your working capital needs. And this is by and large given in the table. In any particular month, the lowest that our inventory is going to be is 43, and the lowest requirement for receivables is 4.1. But when we look at payables, we need to look at the maximum that's going to be required, because the higher our payables are, the better for our cash flow. So the lowest our cash flow requirements are going to be in any particular month is going to be given by our lowest level of inventory, our lowest level of receivables, and our highest level of payables. And if we work that through, then we can say that the minimum amount of cash that we're going to need to cover our working capital needs in any particular month would be 10.29 million. On top of that, there's going to be some fluctuation, and we can work out the fluctuation by first of all establishing the maximum amount of cash that we're going to need and then comparing it to this minimum of 10.29. And that's what we're going to do now. The maximum that we're ever going to have of working capital will be 73.98 of inventory, 8.23 of receivables, less 18.52 of payables. So just working that through, adding together inventory and receivables, subtracting payables, gives us a maximum figure. And comparing the maximum figure of 63.69 to the minimum or permanent of 10.29, we can then see that we have fluctuating working capital of 63.69 less 10.29, which is 53.4. And now that we know the level of permanent net current assets and the amount of fluctuating net current assets, then we can show the amounts involved in the aggressive and the conservative approach. And I'm going to show these amounts involved by drawing a similar version of the diagram to the one that we've just gone through and just marking on the amounts required with each policy. A diagram is not specifically required in this lecture example, but has been tested in real exam questions, so we'll just set it out this way. So if we mark up a diagram with the maximum cash required and the minimum or permanent net current assets required and the fluctuation, it's then relatively straightforward to show the conservative and the aggressive approaches. So with the conservative approach, we're told that 100% of permanent net current assets will use long-term funding, plus 20% of the fluctuating we know is 53.4, 20% of that is 10.68. So our long-term finance will be 10.29 plus 10.68, 20.97, and we can mark that onto the diagram. So 20.97 of our required finance will be long-term. Now we know the maximum we're going to need is 63.69, so the balance must be short-term. So the balance here must be 42.72 to get us up to 63.69. Alternatively, we could work that out as 80% of the fluctuating net current assets. Now let's have a look at the aggressive approach. With the aggressive approach, 80% of our permanent net current assets, so 80% of 10.29, is long-term finance. So long-term finance will only be 8.23, with the balance short-term. And again, we can mark that onto the diagram. So if 8.23 is long-term, 55.46 is short-term to take us up to our maximum of 63.69. Alternatively, you can work out the short-term financing as 20% of your permanent net current assets plus all of your fluctuating net current assets. So we've got a diagram illustrating the two approaches and completing the example. And just to finish off the example and this first topic in the chapter, it's worth noting that most UK firms at the moment would be much more likely to follow a conservative approach to working capital financing, because although in the past they have relied heavily on a bank overdraft, in the current financial environment banks are very nervous about lending to companies, and it would be very unwise to do this. So you'd only follow the cheaper, aggressive approach if you had a cast iron credit rating and you were absolutely sure that whenever you needed short-term finance, it would be made available to you. So for most companies in the current financial environment, a conservative approach would be much more likely. Dividend policy is an important area. In the UK, it's legal to pay a dividend if the directors think it's a good idea, as long as the company has accumulated profits. So it's got some retained earnings that it can use to pay the dividend. So even if you're making losses, as long as you've got accumulated realised profits, then you can consider paying a dividend. But you should be absolutely clear that accumulated realised profits is not the same thing as cash. Cash is actually required if you were to pay the dividend. Which is why we're thinking about dividend policy in a chapter that's linked to cash flow management. There is no single correct dividend policy. This is an area where your own judgment and reasoning will be given generous credit in the exam. But we can say that dividend policy is affected by some general factors for most companies. And these general factors are likely to be the company's investment needs and the company's approach to financing, which we'll talk about below. And as we'll see, we can remember as a series of points in the mnemonic relate. Before we get into that, it's worth noting that dividend policy will be affected by the general state of the economy. So over the years of recession in the UK, so certainly 2009, 2010, generally companies were expected to cut their dividends and to hoard cash to help them to get through the downturn. As we move into 2011, hopefully the downturn is coming to an end and most companies are starting to rethink their dividend policy as a result. Let's start to look at some of these general factors now. Okay, so we've got 6 issues that we're going to talk through, and if you take the first letter of these issues and rearrange them, you get the mnemonic relate, which makes them easy to remember. And the mnemonic relate is also a relevant mnemonic because dividend policy can be seen as simply relating to the investment decision and the financing decision. Let's start with the investment decision. Companies that have got very good growth opportunities will need cash in order to invest. And assuming that these investments are generating excellent returns for shareholders, then shareholders would prefer to have their money reinvested than they would to receive the dividend. So, if investment levels are high, then that's going to mean that you might not have enough cash to pay a dividend, so the dividend will relate to the investment decision. A company is more likely to look for investment opportunities if the tax regime penalises the payment of a dividend and encourages reinvestment. And this is the case in, for example, America, where dividend payments don't get any tax credits, whereas in the UK they do. So this creates a bias for funds to be reinvested. If they're reinvested wisely, it should push up the value of the company. Shareholders can then sell some of their shares, and if capital gains tax is low, they'll effectively get the benefit of those funds without paying tax, or paying a low level of tax. The dividend decision also relates to the financing decision. Let's move on to that now. With financing, we might have covenants on existing debt that mean that we're not allowed to pay dividends or restrict the amount of dividend that can be paid. Also, it might be the case that the directors don't want to take on more debt and therefore prefer to hold on to cash in case it's needed, rather than take out bank loans during the year. We also need to consider expectations. If our shareholders are expecting the dividend to go up because that's what we've said is going to happen, then it will be very dangerous to change the policy. If there's one golden rule to dividend policy, it's to communicate what you're going to do and then to stick to it. Because what you'll generally find is that you have shareholders who are attracted to hold shares because of the company's existing dividend policy. And this is sometimes called the clientele effect. So shareholders who like high dividends will buy shares in certain companies. It would therefore be very dangerous for that company to change its policy. It will result in lots of shareholders selling their shares, which will cause the share price to go down. We also need to consider the expectations of the market and how the market will evaluate our dividend decision. It might be the case that if we put the dividend up, then the market will believe that the directors have insider information about the company that makes them believe that the company can afford to sustain high dividends in the future. The directors generally have the best information, and if they think that the dividend can be put up, the stock market might think that this signals a period of growth for the company, and that can lead to a rise in the share price. There are other factors too. This isn't meant to be a definitive list, but these are certainly 6 general points that you might be able to work into a discussion on dividend policy. It's likely in exam questions that having analysed the factors that might influence dividend policy, you'll actually have to come up with a recommendation about what a company might do. And in this section we're going to look at the types of dividend policy that might be offered and how it might be complemented by scrip dividends or share buybacks. First of all, let's look at practical dividend policies. First of all, a company might decide to pay out a constant % of its earnings as a dividend. Kellogg's are a good example. Over the past few years, Kellogg's have maintained their dividend payout ratio at almost exactly 45%. Now, this should make sure that the dividend over the long term is affordable, and it gives the dividend a rationale. The drawback is that as profits go up and down, the dividend will as well, and that will create perhaps unexpected dividend movements for shareholders, which may not be attractive to them. So it's a policy that you could logically recommend, but its downside is volatile dividend movements. Another policy that you could use is to try and set the dividend growth at a level that the directors think are sustainable for that particular company, and to get rid of the problem of volatility. The outsourcing company Capita used this approach, and in the 5 years to December 2010, they maintained their dividend growth at approximately 23% per year, with a little bit of variation year to year. But in their accounts, they very clearly broadcast that the average annual growth rate was 23% over the previous 5 years. And that's almost acting as a signal that they think that they can maintain it. At the other extreme, some companies allow their dividends to fluctuate quite wildly and will pay a generous dividend if they don't have any investment projects, but no dividend at all if they're investing heavily. As we've already mentioned, Ryanair to date has not paid a dividend, and that's because it's been reinvesting very heavily and has not had any cash left to pay the dividend. However, it has indicated that in the near future, as its investment slows down, it will start to pay reasonably generous levels of dividends. And this is an example of something called residual policy. We'll talk a little bit later in the chapter about which of these policies might be most appropriate. But in the exam, you can justify any of them if your logic is sound. To complement the payment of a cash dividend, a company will sometimes offer a scrip dividend, which typically will give shareholders the choice of taking extra shares instead of cash. This is a useful complement to a cash dividend policy, and it allows some shareholders the choice of building up their stake instead of taking the cash. If they do build up their stake, then clearly the company doesn't have to pay the cash out, and that can give a welcome cash flow benefit. Finally, if a company has decided to return cash to shareholders, they might consider doing this by means of buying back shares instead of paying a cash dividend. We'll talk about this in lecture example 2. Lecture example 2 looks at a real example of Marks & Spencer's in 2004 buying back more than a quarter of their shares, which at that time was the biggest buyback ever seen in Britain. So they bought back 635 million shares at a price which was a slight premium to the existing share price, £3.62. This allowed them to return £2.3 billion to their shareholders without actually increasing the dividend. And they've continued to do many buybacks since, as have many other companies. Pause the presentation here and try and think for yourself about why they may have chosen this approach. It will be difficult without knowing the precise background, but just think a little bit about why buying back shares might bring some general advantages. You're unlikely to have thought of all the points that we're about to go through, and you may well have thought of some of your own. But nevertheless, it's really good if you can to start to think about this paper for yourself. And whenever we come up to an example, it would be very good practice to pause it and have a think about it before going through it. Because when you start to look at exam questions, it's your ability to think through problems for yourself that is going to matter. Right, let's think about share buybacks. For Marks & Spencer's, they had a cash surplus after selling Marks & Spencer's money in 2004. That's a good reason for a share buyback. If you increase the dividend, you tend to increase expectations. And if you've got a one-off cash surplus from selling a division, then you're more likely to go for a share buyback rather than build expectations of dividend increases. Secondly, the shareholders who choose to sell shares back to the company may well be the same shareholders who would sell out to somebody launching a takeover bid. So we could say that this is a defence against a takeover. The shares were bought back at a 5% capital gain. And that gives the advantage of low rates of capital gains tax, if that's the case in that particular country. A share buyback is a good way of dramatically increasing your gearing. Some people think this is a good thing. We'll look at the debate about gearing levels in a later chapter. And finally, if you buy back shares, it can have a cosmetic impact on things like earnings per share, as there are fewer shares in issue. Share buybacks have become quite popular in recent years for these sorts of reasons. Right, we'll close off this chapter with a brief consideration of a theory called dividend irrelevancy theory. That's a Modigliani and Miller theory that you're required to know for the exam, but in reality is not terribly important. So for the exam, it's important that you can say that Modigliani and Miller, who we talk about in more depth in chapter 9, suggested that whether or not you pay a dividend actually doesn't matter. And it doesn't matter because if a company, for example, decides to cut the dividend to invest money in wealth-creating projects, then shareholders will benefit from the wealth-creating projects, and if they want to, they can sell some of the shares themselves and make their own dividends. So they're not going to mind if the dividend is cut. It's not a very relevant theory for a number of reasons. First of all, it assumes that if you pay a dividend and then later in the year you want to get hold of some more money, you realise you need the cash, then you can go out and get a bank loan or a rights issue without incurring any fees. Now in reality, rights issues are very expensive and a bank loan might not be available. So it would be very relevant to a company whether to pay a dividend or not in the real world. Dividend policy is far from being irrelevant in the real world. Dividend irrelevancy theory also assumes no taxes. Now we've already said that particularly in the USA, you're likely to pay no low dividends because once you pay a dividend, it's going to be taxed as income for the shareholder, and it will already have come out of corporation profits, which will have been subject to corporation tax, so it's taxed twice. Whereas if you reinvest it within the business, then you can create capital gain, and if capital gains tax is low, that might be better for your shareholder. So again, dividend policy is relevant in the real world, but the theory suggests it's irrelevant. So dividend irrelevancy theory, you need to know it for the exam, but it's not a sensible theory in reality because it assumes no transaction costs and no taxes. Because the theory isn't very helpful here, it's more helpful in the exam to think about the life cycle stage that the company that you're talking about is in. And if the company is young, then you would normally envisage that it had many different investment options, lots of projects it wants to invest in and should invest in. And so much like Ryanair, you'd expect it to follow a residual policy and put the investment decision first. Whereas a more mature company like Marks & Spencer would have limited investment needs and could fund its investment through debt finance. And it would be more happy to take on debt finance because it's got mature and reliable cash flows. This isn't a bad framework to use in the exam, but you can have an open mind about it and you can use your own common sense. And this sort of life cycle approach can be criticised. For example, a young company might be a private company. And if it's a private company, if it's a private limited company, then its shareholders will find it very difficult to sell shares. So they'll actually want some returns from their investments. And so a young private company might well find itself under pressure to give some returns to the shareholders, which will mean paying dividends. A young company that's listed might also consider paying dividends. In 2011, Echo, which is one of the UK's leading speech recognition companies, a high-tech company, announced that it was going to start paying a dividend. It's a young company in a volatile industry, exactly the sort of company in theory that we'd suggest would not pay dividends. But its managing director said that they wanted to pay a dividend because it would encourage them to manage cash flows more carefully and to manage their balance sheet more effectively. So, for example, their working capital more effectively. And they see the payment of a dividend as an important discipline for a company. That's their view. Many people would disagree. In the exam, don't feel reluctant to express your own opinions. this is an area where they will be rewarded. Because this is a discussion chapter, it's very easy to neglect it. In the exam, however, it's absolutely crucial that you recognise the term aggressive working capital finance or conservative working capital finance, and that you can identify this strategy and comment on it. Dividend policy is certainly an area where we'd encourage you to read a good quality paper every Sunday and actively search out articles on dividend policy, or go onto the Financial Times website and type in dividend policy. Look at a few companies and what they're doing, and see some of the issues that are involved. Make sure that you go into the exam with the ability to discuss dividend policy in general terms and what sort of practical policies might result from those considerations. Get used to thinking about life cycle issues as well. Finally, even though dividend irrelevancy theory is not particularly useful in reality, make sure that you're comfortable commenting on it in the real exam. And that completes the debrief to this chapter.